What we're waiting for is more information on a number of recent developments, including the effects of recent weather disturbances and possible more information on the likelihood of a reasonable monsoon. Given that there has been also very little transmission so far from the rate cuts that we effected at the beginning of the year and in March, we're waiting to see transmission taking place. The bulk of this policy is focused on measures, structural reforms, you may call them, to improve the working of the financial sector, including transmission. So the message from this review is that while we are status quo on policy, we are not status quo on all the measures needed to take the economy forward onto a higher growth path. These include, amongst others, as I said, first, ways to improve transmission, but also a number of measures intended to facilitate the financing of growth going forward, as well as to improve the liquidity of financial markets. So with that, perhaps we can take some questions and elaborate on the details. But again, let me emphasize, the fact that we haven't moved on policy rates doesn't mean we haven't moved. We've moved on a variety of other dimensions.
Questions? Gopika? Governor, this is Gopika from ET Now. Now with the onus of future rate cuts falling on banks and monetary policy transmission, how much of transmission do you expect from the banks? With most banks saying that they do not expect to pass on the previous rate cuts, say 50 basis points, how much do you think is warranted so that transmission is effective?
I don't think we're looking for a specific number and saying unless this happens, nothing more will happen. But we want to facilitate the process of transmission. I don't see an environment where credit growth is tepid. Banks are sitting on money, so to speak, and their cost of funding, their marginal cost of funding has fallen. The notion that it hasn't fallen is nonsense. It has fallen. They can borrow at the margin today at 7.5%. We've kept it. There's plenty of liquidity in the markets. So at some point, the pressure on the banks, the competitive pressures will tell, as it is a number of corporations are borrowing directly from the markets. You've seen that announced even today. So I have no doubt that this will happen. If it happens sooner, it's better for the economy, but banks have to make their own decision.
Saloni?
Governor, just taking that particular point forward, you mentioned here that your stance remains safe. But going forward, you will look at whether the transmission is happening or not. So I just wanted to understand, since January, we've seen 2 out-of-policy rate cuts. Going forward, there is a, street is divided whether Fed will go and start tightening their own monetary policy by June or September. So going forward, just trying to understand the policy guidance, is another out-of-policy rate cut, expected? Because till June, there will be 2 more CPI datas that you will get. So just wanted to...
We, as I said, I can't go further than saying we are waiting to look at the data. Our stance turned more accommodative in January, and it remains so, which means you shouldn't expect the direction to change in the future. The timing of future cuts will depend on how much room we have, and we've outlined a number of factors we're looking at. We're not saying everything has to happen, but we're saying we'd like to see some more of what we need to see happen. As far as Fed policy goes, we are not, in some sense, saying that that will be a determinant. We are more focused on the domestic economy and the domestic requirements. Of course, Fed monetary policy has an effect around the world, but at this point, as we say in the statement, we feel we are adequately buffered. And so that is not going to be a key factor or the key factor in determining our monetary policy stance going forward.
Sandrine?
Samantha Castello, Bloomberg. So you repeat in your statement that you will be data dependent, and you also have a whole report that mentions the uncertainties around GDP. The same way that Janet Yellen has a dashboard that's very much discussed in the US, I was wondering whether you have a dashboard and you could give us some guidance on what it is and what maybe you wish you had on it but doesn't exist today in Indian data.
Would you like to take that?
We don't have a dashboard, but or at least in the formal manner that the Fed possibly has. The most important variable that we have to look at, of course, is the CPI outturn, both in the immediate run and going forward, looking through temporary changes. We also, regarding output and GDP growth, we do look at high-frequency indicators such as cement production, freight, airline, IIP, etc. And those have been taken into account in making our GDP forecasts in the monetary policy review and in the statement itself.
Pradeep?
Governor, what kind of impact will it make to the base rate really if you shift from average cost of deposit to marginal cost of deposit, because there is always an equation which is used. So, you know, the equation or the function could be also be changed so that the result remains the same.
See, that's why there has to be both the incentive or willingness for banks to move, as well as the flexibility on the regulation or the calculation. I think we need both. In terms of the incentive for banks to move, as I said earlier, the fact that credit growth has remained relatively weak so far, that there's a lot of competition building up in the markets. Markets seem perfectly willing to lend at lower rates now. And so banks over time will be forced to match the markets and will have to bring down their rates. So what we have to make sure from a regulatory perspective is the regulation is not standing in the way. And to the extent that people focus on average cost rather than marginal cost, it's much more slow moving. So we have to try and deal with that. Now, remember that the base rate doesn't seem to stand in the way of banks raising the base rate when interest rates are raised. It only seems to come in the way when interest rates are cut. So we have to think about both incentives as well as the actual structure of regulation. And both, when working together, will help transmission.
Yes, Lata. Morning, Governor. You have said that inflation goes down to 4% around August. That's the RBI's forecast, and then climbs back to 5.8%. And then your old monetary policy stance remains that you want the real return to be 1.5 to 2%. If you add that 1.5 to 2%, say 1.75% to your 5.8 ultimate inflation number, then technically there is no scope for any further rate cut at all. You're already at 7.5, which is 5.8 plus 1.75. So at 4%, what exactly do you mean? Is that because of base effect? Because you're also saying you will look through base effects and seasonal effects. Is this 4% because of base and seasonal effects? How will you respond to the 4%? How should one look at the future movement of monetary policy?
Yes.
As well, I want to know if you are taking cognizance of the fact that small-scale savings at 8.75% will further stymie banks' position in terms of reducing deposit costs. I wanted your comments on that as well.
Well, let me start with the second. First, banks have already reduced in a number of situations deposit rates. So it's doesn't seem to be an absolute barrier. Of course, we have to make sure that small savings rates don't stand in the way of banks further reducing the cost. And the government has said it's going to tie them to government securities rates. As far as the 4% in August goes, that's largely because of base effects, but Urjit can correct me if I'm wrong. And when we say we're looking through base effects and seasonal effects, it means two things. One, the seasonal price rise as a result of vegetable prices, as well as perhaps because of weather disturbances, is something we can look through. So we're looking through the ups as well as the downs to try and see whether the incremental inflation is down to a level where we have the ability to accommodate. We've talked about a number of data variables which will be important in determining this. I think it's the composite picture that we'll be looking at rather than any single data variable. And what we're saying is we just did some. Let's wait for transmission, and we'll also get more information and be able to make up our minds about the next step after that.
Arithmetic itself. At 5.8 plus 1.75, by your own arithmetic, there isn't any scope for cuts.
Well, if I wanted to be hawkish, I'd say 5.8 plus 2. If I wanted to be dovish, I'd say 5.8 plus 1.5. So there is room if we want to look for it. We just need all the other pieces to fit into it.
Joel?
So I'm Joel, I work for Mint newspaper. I didn't have the time to go through the whole financial market efficiency measures. If you can take us through the top three, measures and your rationale behind it, and how do you think that will help our markets?
Let me talk about a number of measures. Just in order, there are some regulatory measures to meet our Basel requirements, one of which is we've put in place a counter-cyclical capital buffer. We're saying we don't need it right now, so we're not activating it right now. We had allowed banks to issue long-term infrastructure bonds. We're now saying that other banks can hold, Bank B can hold Bank A's infrastructure bonds up to a certain limit in order to facilitate trading. This is a request from the banks, and we think it's reasonable with some caveats on that. We're going to look at the base rate, and we're going to try and push banks towards marginal costing of the base rate rather than average costing so that they can move more quickly. And marginal costing seems the right thing. If you are able to raise deposits going forward at a lower rate, that should feed into your base rate more quickly. We're also going to have financial benchmarks on money market rates, for example, so that banks can use that to determine their lending rates. Instead of having a base rate, use the money market rate, short-term, medium-term money market rate to read off their rates, just like LIBOR. We want to move towards that quite quickly. Two important issues on bank governance. One, we had prescribed a very detailed set of calendar reviews that banks had to do. You have to do this by this time, that by that time, very detailed. What we're doing is we're doing away with it completely. We're saying bank boards can now look at 7 elements which were prescribed by the NAI committee. These are just 7 things that are important, like risk management, strategy, human resources management. They can figure out how frequently they want to look at it, when they want to do it, how they want to do it. We're just liberating the bank boards to use that time better. We're also recognizing the need to bring in high-quality professionals into bank boards. Earlier, we had limited how much professionals could be paid on bank boards. We are still going to limit it, but in a way that makes it competitive, the pay structure for bank boards comparative with other boards so that they can attract high-quality people. And we're going to work with the government to ensure that similar compensation is available for public sector boards so that public sector boards are no worse in competing with private sector boards. We are allowing well-managed urban cooperatives to issue credit cards. And we're also allowing a number of state cooperative banks to open ATMs without having to go back to the Reserve Bank. As far as trading goes, 2 main issues with government bond trading. We are looking to set up primary dealers to work as market makers for a number of illiquid bonds so that we get liquidity across the spectrum. And we're also going to make it easier for individuals to trade government bonds. Now, typically, there isn't a huge amount of individual demand, but it shouldn't be that roadblocks are in the way of individuals buying government securities, and we're going to ease the way in a number of ways. We're going to open up the possibility of Indian corporations issuing rupee bonds abroad. Now, that's a big thing because a lot of investors want to come to India to buy corporate bonds today. we're going to allow the corporations to issue abroad so that it can be traded abroad. Now, this will come under the overall ECB window to some extent, because in a sense we are replacing people having to borrow in dollars to people being able to borrow in rupees and not then having to hedge it. Our corporations will not have to hedge it. This is, I think, a big development. We already have people like the IFC, the World Bank, thinking of issuing these bonds. Why not our own corporations? So that is a movement forward. Some movement on options, and then there are some announcements which will come today, which came yesterday, come today on further developments that we are undertaking. The priority sector guidelines will be issued very shortly. We've got comments. We're going to look at them in detail and then issue final instructions later before the end of this month. We are expanding the loan limits for microfinance institutions, consistent with the fact that we've had inflation over the years, and they've asked for an expansion, which we think is warranted. And finally, NBFC IDFs, in order to lend to certain kinds of projects, there were some constraints because we had required them to have something called a tripartite agreement. If you have questions on that, I can answer. But what we've done away is the need for tripartite agreements, a long-standing request, but which will facilitate NBFC IDFs in lending to infrastructure projects. So those are some of the broad elements, but this is an ongoing process. We just collected some of the ones that we had in the works, but more will come. Structural reforms are well and truly alive.
Govardhan?
Both of the Economic Times. And now, when it comes to the U.S. interest rates hike, seems to be getting pushed behind, or it's going to be a lot lesser than what it was anticipated. Does that mean that you get a bigger window for you to lower rates than what it was about a few months back? Is that why that you held taking any measures in this policy?
I would say, let me repeat, the Fed's policy changes will have an impact globally, but that is not our central concern. When it comes, there will be some volatility, but what the improvement in macro policy, both from the government side as well as the RBI side, as well as the buffers we have built, give us is the luxury of being able to focus a little more on domestic policy and domestic policy requirements rather than what's going to happen internationally. So I'm not saying that that is irrelevant. That's number 4 in our guidance, but it's not the central issue. And I'm not too worried that concerns about when the Fed will move and how much will affect our own policy sort of process. It will be one factor, but not the most important factor, and I doubt it will be constraining in terms of when we move again.
One more. On priority sector, about the working group recommendation, there seems to be kind of...
Keep your mic closer to the...
So there seems to be kind of a one-size-fits-all for all the banks, be it a foreign bank or a private bank or a state-run bank also. That seems to be missing that kind of every bank institution will have its own strengths and weaknesses. So what is your reading of the working group recommendation?
We, as I said on the occasion of our 80th anniversary celebrations, are moving towards an ownership-neutral kind of structure, institution neutral, ownership neutral. We're doing it for the NBFCs, we're doing it for the banks. There should not be an unlevel playing field. What we are saying is, yes, we recognize certain banks have certain expertise, and therefore let them trade that expertise through the priority sector lending certificate. So if some bank can do more of agri, can sell those certificates to the foreign banks. So what we do recognize is that there is an adjustment path that is needed, and we will take that into consideration when the final guidelines are put out. But the notion that we have to maintain this unlevel playing field is probably unwarranted.
Amol?
Hi sir, Amol from Z Business. मेरा सवाल सर
Put your mic close.
Hi sir, Amol from Z Business. मेरा सवाल NPA से जुड़ा है. आपने लास्ट टाइम कहा था कि फाइनेंस मिनिस्ट्री से आपने बात की है डीआरटी का प्रोसेस स्ट्रेंथन करने के लिए. मैं जानना चाहूँगा उस पर क्या अपडेट है. एंड ऑन द सेकेंड साइड सर, एक तरफ बैंक्स आर इट्स डिफिकल्ट फॉर देम टू रिकवर द मनी फ्रॉम एनपीए. एट द सेम टाइम इट्स चैलेंजिंग फॉर देम टू रेज द कैपिटल एज वेल. ये जो सारा एनपीए जो है एक दिन में नहीं हुआ है, बिकॉज आरबीआई के डेटा के हिसाब से 6 लाख करोड़ से भी ज़्यादा का एनपीए है. तो आरबीआई के भी इंस्पेक्शंस होते हैं, बैंकों के भी डे टू डे ऑडिट्स होते हैं. क्या ये चीज़ को तभी देखा नहीं गया था? आपको लगता है कि वहाँ पे ज़्यादा इश्यूज तब हुए थे और ज़्यादा उसको गौर से नहीं देखा गया था? हाउ आरबीआई इज लुकिंग एट दिस एंटायर इशू?
Let me ask Mr. Mundra to speak on the NPA issue. Let me address the DRT's issue. Dr. Adya from the DFS has been looking at this issue. Of course, he is better placed to answer the question that you asked me. But we have sat together. He has come to talk to the DRTs and understand some of the concerns that are keeping them from expediting cases. And I think the DFS, Department of Financial Services, is well embarked on the idea of expanding their capacity to move faster. So you should ask him for the details, but certainly this is an issue that the government is looking at, and there will be moves to address it.
In the regarding NPA which you have mentioned, I think it would be too simplistic to put it like this, that if there is a continuous process of audit or inspection and NPA built up, or the weakness which is coming to the system can always be seen much in advance. We have to appreciate there are a number of facts which are in play. One, in post, say, 2008-9, lending was predominantly directed to a sector which was a relatively new sector in the lending, that is the infrastructure. Then, of course, there were the policy-related issues or delays. Those were the issues. Within individual institutions, there were the issues about the leadership or the vacuum, and then overall, of course, the global environment as well. So I think these are the facts which come together and play into the formation of NPA. What is important that this was recognized quite early by the Reserve Bank, you must have seen. And in last few months, that entire mechanism of early recognition, resolution, moving towards the formation of joint lending forums, taking a decision within a given time frame. I think these are the steps which are in right direction. So the moment this kind of trend is spotted, and then the enabling measures are put in place. I think this is how you have to look at it.
Yeah.
But sir, do you see any time frame that the money will be recovered soon?
I think to put a time frame to any of these things, if you feel convinced that the question which you are asking you can reply yourself, then I will also try to reply.
Yeah. Can we quickly check with invite? There's something on your side.
Sure, ma'am. We'll now take questions from participants on the audio bridge. Anyone who has a question may press star and 1 on their touchtone telephone. Our first question is from Manju of DNA. Please go ahead.
Good afternoon, Governor. I just wanted to ask you, the banks are not bringing down the rates. They are investing into commercial papers of companies at much lower rates. Is there any risk involved in this, and are you taking cognizance of this? The second question I have is, why has RBI allowed banks an extended time to restructure their debt if references are made either to the CDR or JLF before March 31st? Why did the circular come on 30th of March? I mean, then almost all must have been done. Or was there a bunching up of debt that remained to be restructured?
Let me address the second issue first. I think the rules of both the JLF basically allow any entity that goes into the JLF 120 days to figure out what needs to be done, and at the end of it, as an incentive to do it fast, the asset classification that prevailed before it went into the JLF persists. So all we're saying is this continues to hold even post March 31st. Now, that does give a little bit of time for companies for banks to deal with problem companies and so on. But the notion here is it's really a softening of the end of forbearance rather than any change in the fact that forbearance has come to an end. Now, why didn't we say this, a quarter or two ago? Well, perhaps that would have given banks an incentive to wait a little longer before addressing the issues. And I have repeatedly said the faster banks address issues, the better it is. So basically, we, said on March 31st, anything that's already come in gets that 120 days to fix it. So you don't have to sort of rush head over heels to do this immediately and do bad deals as a result. But there's no more forbearance after this. Anything that goes in after this does not get forbearance. The first question was on CPs. Yes, banks are. I mean, this is part of the issue, right? That banks are able to lend at lower rates today, which is exemplified by their buying CPs. So we do have to look at the institutional constraints on them not cutting rates more generally through the base rate system, which is what we're partly trying to address with this encouragement towards pricing on the basis of the marginal cost of credit. But I think the incentive for them is also clear because they're lending to companies at the commercial paper rates that's suggesting that they're happy to pick up the returns that are available today in those kinds of markets, which means they should be happy to lend at those rates to normal customers going forward. So I think the adjustment is a matter of time. And given the amount of liquidity that is going to be released during this month, March is a tight month, April is much less tight, I think there will be incentives for banks to cut rates.
Next question, Inba.
Sure, ma'am. The next question is from Radhika Mervin of Hindu Business Line. Please go ahead.
Yeah, good afternoon, sir. My question pertains to the the IDF NBFC leeway that you've given on the PPP project. If you can elaborate a little bit, because as I understand currently, these debt funds can fund NHAI projects, port projects, etc. So what is the kind of leeway are we offering to other projects?
Let me ask Mr. Gandhi to reply.
Yes, IDF, they have been permitted to get regulatory forbearance for those kind of support which they give where there are PPP and tripartite agreements. When there is no tripartite agreement, they do not get that regulatory support or the forbearance. That is where they have been representing. There are other infrastructure projects where there is no possibility of tripartite agreement. So those projects should also be permitted for them to be financed. So that argument we agreed. So that's the one we are permitting now. And second, they also mentioned that there are other projects where the DCCO has already happened. It is already an operational project. After 1 year, why they cannot be financing? That also we have accepted, and now they can finance those projects as well. So the idea is that the IDFs should be financing less risky projects wherever it is possible.
Okay. So ideally, these will still fund operational projects, or are we actually expanding the ambit of bringing other projects as well?
No, they have to go in only for operational projects. Only after completion of the project, DCCO is over, and after 1 year.
Okay. And my second question pertains to the benchmark
I think this is question number 3. No?
Just one final
okay.
question, sir. This is on the benchmark that you mentioned that will be provided to price banking products. As I remember, according to the Urjit Patel committee recommendation, we have been, talking about the term repo, across different tenures, acting as benchmark, to price different, deposit rates across different tenures. So, are we talking on the same lines when we are talking about benchmark indices here?
No, yeah, basically what has been indicated that both the asset side and liability side, if they have to be priced with reference to a particular market interest rate, there has to be some benchmark. So that because the transmission is not happening because advances are tied to different benchmark and deposits to different benchmark. So that is why the whole concept of this market interest rate benchmark, which the new company will try to put out. That's the idea. It is not directly related to the term interest rate thing which has been talked about.
I mean, the idea here is to get a believable benchmark, and that is what the company is set up to do. Based on actual transactions. Now, those actual transactions may be loan transactions for one kind of benchmark. It may be your term repo, the 14-day term repo, for which there's an established interest rate nowadays. It can be other term repos. I mean, this is something the company has to figure out what demand there is in the market. We hope the company will set up in the next 2 months and start working out different benchmarks, and then banks will be free to pick up those. There is, an issue that sometimes is raised about the benchmark of which banks price their loans being determined by the banks themselves. And so this would provide an exogenous benchmark which they can use.
Okay. Thank you so much, sir.
Thank you, Inba. Last 2 questions from this room. Aparna.
This is Aparna from Financial Express. Sir, I have 2 questions. One is on liquidity, since it's an important dimension when it comes to transmission. Now, we have been looking at credit growth all along, but even deposit growth has fallen from a high number to as low as 11.4 this fiscal. When I checked the data, it was a 50-year low. So, does the RBI in future anytime see a structural issue in liquidity? And I mean, do you foresee a trouble where it can hamper bank lending or business of banks? And my second question is on the unhedged forex exposures. You have been warning companies that please do not keep it open simply because the rupee is stable right now. I have heard from banks that they are still not interested in hedging their forex exposures, and a lot of open exposure is still there. Do you see the risk of these exposures still pertaining? What's the update on that?
Well, first on deposits growth being also lower. I mean, clearly there is some disintermediation also going on, that there is some direct raising of funds from the markets, whether in terms of commercial paper or in bond issuances, which is bypassing the banks. And this is why I have said that at some point banks will have to react so as to recapture some of that business. And let us wait and see how that happens. There are also structural constraints that we have to look at, but I don't think right now they're the determining factor. Constraints such as the small savings rate and so on. As far as the second question, unhedged exposure. We can exhort the banks can exhort the companies, but at some level, until you have, very, very intensive monitoring of what the companies do, it's hard to, you can take a horse to water, but you can't make it drink. That is where the notion that volatility can happen anytime, and that we are not going to be focused on holding the rupee at some particular level without any change. That should be clearly communicated to companies also, that or they should have absorbed it by now, that our focus is on undue increases in volatility, but we're not going to maintain any particular level for the rupee. And so they have to recognize that they're taking on a big risk, especially if monetary conditions change around the world. So I think that we will look at our current regulations and see how we can make them more effective, but also companies should absorb the message that it is in their own interest. And this is where I think the possibility of them raising money in rupee bonds outside and using that would be an alternative to borrowing ECBs in dollars and holding it unhedged. The other factor that one must recognize is we are also trying to improve the extent to which distress is resolved. If distress is always resolved with banks taking the hit and the promoter not going scot-free, there's an incentive sometimes to take certain kinds of bets. They become one-way bets. If the dollar strengthens against the rupee, the banks take the hit. But if the dollar weakens, the equity holders benefit. So that also is something that hopefully the measures we have taken will try and convince people that that kind of negotiation is unlikely to happen going forward, and that banks are not going to forever take the downside hit when positions are left unhedged.
Last question from Alek.
Hi, Governor. This is Alek from Cogensis. Could you tell us the rationale behind allowing banks to cross-hold infrastructure long-term bonds? Because the idea was to get long-term money from, say, PFs and insurance. Could you just explain on that?
Yeah, the idea is not for this to be another source of financing. It'll be very limited. Some fraction of their assets, small fraction, single-digit fraction of their assets. It's primarily for trading purposes. So what the bank said is we are a big part of the trading community here, and liquidity in these bonds will be enhanced if we can use some of them for trading. To make sure there's no incentive to overhold these bonds, we are essentially subtracting the benefit a bank gets from the bonds it has issued by the number of the bonds it holds, so that there is no double counting of these benefits. In fact, only single counting, and bonds held for trading come at a cost. So we just ensuring that these are used for trading rather than become a way of bank A holds B's bonds and B holds A's bonds, and they both get all the priority sector as well as liquidity benefits.
That's it.
But let's take one last question because...
Take the mic. सर पिछले बार जब रेट कट होने लगे थे, जब बैंक्स भी इंटरेस्ट रेट घटा रहे थे, तब हमने देखा कि जो लोन्स हैं वो पुराने ग्राहक के लिए तो सस्ते नहीं हो रहे थे, लेकिन नए ग्राहक के लिए ज़रूर सस्ते हो रहे थे. तो इस बार जबकि अब रेट कट साइकिल फिर से शुरू हुआ है, आरबीआई किस तरह ये इंश्योर करेगा कि पुराने ग्राहक के लिए भी जो है लोन सस्ता होगा?
To the extent that a loan is tied to a benchmark like the base rate, then when the base rate comes down, the loan EMIs will also come down. So anything that is tied to a common rate will adjust accordingly. So we don't have to issue special new instructions to make sure that this happens.
Thank you very much. Thank you, sir.
Thank you.
Thank you.